Good morning, restaurant owners. This is take two. That first take, we had a little technical difficulty, but we'll dive right back in and start up. Welcome back to our weekly live training. My name's Tim Cernett, founder of Financial Optics, where we help independently owned restaurant operators improve profits and cash flow. Over the last 5 weeks, we've covered a lot of ground. We started with the 5 moves that separate profitable restaurants. We then went deep on food cost control tools, menu engineering, and 2 full weeks on labor strategy, scheduling, and cost control. That's a lot of tactical value, and every one of those tools works. But here's what I want to talk about today, because it's something I see over and over again with restaurant owners, and it's the thing that keeps all those tactical tools from delivering their full potential. So let me share my screen and we'll get started on this week's presentation. Okay. And we're at why financial systems break down in restaurants. When I work with restaurant owners, I often see something like this. The restaurant owners know they should be tracking food costs better and should be scheduling from productivity data. They've even tried to implement some of the tools that we've covered in the last 5 weeks, but the numbers they're working from just don't feel right. They might say something like, the P&L shows a profit, but I don't see it in my bank account. I can't tell if my food cost is really 32% or 35% because the data changes depending on how I look at it. I'm making decisions, but I'm not confident the information is based on accurate numbers. If that sounds familiar, the problem probably isn't your effort or the discipline. The problem almost always is underneath it, in the financial systems and the infrastructure that everything else is built on. I just noticed I need to advance my slide. Strong profits and ideally healthy cash flow are outputs of strong financial systems. When those systems have gaps, many independent owners realize there's gaps and the systems show up everywhere. Unreliable food cost data, labor numbers that don't match reality, cash flow that's unpredictable despite decent sales, and the P&L that creates more confusion than clarity. Today, I'm going to walk through the 7 most common financial system breakdowns I see. For each one, we're going to explain what it looks like, what it potentially costs you, and where in the training series here that we go deeper. This training series is presented over a 13-week period, and then we'll rotate and just kind of start over again. So today we're on week 6, and I'm going to show you with each problem that we discover and describe where in the training system series it falls. This isn't a fix it all today training. It is to see clearly where the gaps are, because diagnosis before prescription is how we do things at Financial Optics. Okay, the 7 system breakdowns. Most restaurants have at least 3 or 4 of these. Some have all 7. Each one quietly erodes your profits month after month. So number 1 is the chart of accounts, not built for restaurant. Point of sale integration, systems are not connected. A labor separation, no back of house versus front of house detail. The food cost formula is wrong. It is not purchases equal food costs. Cash versus accrual, you're on a cash basis and it's distorting the monthly picture. Timely reporting, reporting is late and it's a history lesson, not a tool. And you're flying without an operating plan, flying without a destination. These 7 breakdowns aren't ranked in any order of severity. They all matter. But I'll tell you this, most restaurants I work with have at least 3 or 4 of these. And the cumulative effect is that the owner is making decisions from incomplete, inaccurate, or untimely information. That's not a recipe for improving profits. That's flying blind and almost always hurts profits and cash flow. So let's get into it. Breakdown number one, your chart of accounts isn't built for a restaurant. This is the most common problem I see, and it's the one that affects everything else. Most restaurant accounting systems are set up with a generic small business chart of accounts. And that generic chart of accounts doesn't give you the detail you need to run your restaurant. If you can't see sales broken out by food, beer, wine, liquor, and NA/Bev, if your cost of goods sold isn't broken out in the same way, if your P&L shows you one big sales number and one big cost of goods sold number, your financial statements can't tell you where the problems are. They're compliance documents for your tax return, not management tools for running your business. A restaurant-specific chart of accounts is the foundation. Without it, everything else we've talked about in the training series, food cost tracking, menu engineering, labor analysis, it's built on unreliable data. We went deeper in week 1 with the 5 moves, and we'll go deeper in week 8 upcoming with streamlining your financial systems. Now, again, remember this is week 6, so week 1 can be found on our YouTube channel or here in Facebook page. However, the Facebook page only retains long videos for 4 weeks. So for week 1, and as they age, you'll need to go to the YouTube channel. And we'll go deeper here in week 8, streamlining your financial systems. All right, breakdown number 2. Your point of sale system isn't integrated with your accounting system. So your point of sale system collects a whole bunch of valuable data. Sales by category, guest counts, check averages, hourly volume. Your accounting system is supposed to turn that data into financial intelligence. But in a lot of restaurants, those two systems don't talk to each other. They're not connected. The sales data gets entered manually on a daily or sometimes weekly basis. And there's a chance for errors, delays, and missing information. When your point of sale system is integrated directly and synced with your accounting system, sales flow automatically, categorized correctly, assuming all the mapping is done correctly within the point of sale system when it's synced to your accounting system, which a lot of times is where we get involved. If that's not set up, you're working with stale, estimated data for profitability analysis. And every decision built on that data inherits those same approximations and inaccuracies. So we'll go deeper on this in week 8, streamlining your financial systems. Breakdown number 3, no separation of back of house and front of house labor. Okay, we just spent 2 weeks on labor strategy. Every tool we covered, sales per labor hour, scheduling from productivity data, shift management, that all depends on knowing your labor costs in detail. The most important detail is in the separation between back of house and front of house, and even beyond that, separation and tracking by position, so we can go deep in the budgeting and planning process. If your financial statements show one lump sum number, for labor, you can't see where the labor cost problems actually are. Back of house and front of house are completely different dynamics, different wage structures, different scheduling patterns, different relationships to revenue. Managing them as one number is like trying to manage food costs without knowing the split between food and beverage. You can see the total, but you can't act on it. We just went deeper on this in weeks 4 and 5, a lot of detail and a lot of live examples of how to accumulate this information. So go back and look at weeks 4 and 5 on labor strategy and building a labor budget. It's one of the most important tools levers you can pull in your restaurant to improve profits and cash flow. Okay, breakdown number 4. Food costs reported as just purchases, not the real formula. We covered this detail in week 2, but it's so important I'm bringing it back up here again in this summary week. A lot of restaurant owners, and honestly a lot of bookkeepers, calculate food costs as purchases divided by sales. That's not food cost, That's a purchasing activity formula. The real food cost formula is beginning inventory plus purchases minus ending inventory equals usage. Now you'll notice that formula involves the word inventory. There's only one way to accomplish this and actually have inventory systems built into your accounting and financial reporting workflow. So the formula again is beginning inventory, and that's going to be the beginning of whatever period you're measuring. If you're measuring the food cost formula for the month, that's the beginning of the month, plus the purchases during the month, minus the ending inventory number at the end of the month. That gives you your usage dollars. So the real food cost formula is then the usage dollars divided by sales dollars. That gives you your true cost food percentage. Now, if you're not taking inventory and running the real formula, every food cost decision you make, menu pricing, purchasing, waste tracking, it's all based on estimations and approximations. And estimates don't improve profits, and inventory tracking should be monthly at a minimum. Okay, a simple example on a restaurant doing 200,000 a month in revenue, every half a point error in understanding your food cost percentage, that's $12,000 a year. Just a half a percentage point is $12,000 a year. All right, let's move on to breakdown number 5, cash versus accrual confusion. Now, here's one that's a little accountant or bean counter nerdy, but it's important and it can create a lot of confusion and bad decisions. So let's clarify it and understand exactly what system you should be using. Cash basis accounting records costs and expenses when they're paid. Accrual accounting, let me back up. Let me say that again. Cash basis accounting records costs and expenses when they're paid, not when the inventory was received or the expense or service was performed. Accrual accounting records those costs and expenses when they're actually incurred, when the product is actually received or the expense or service is actually provided. And in a restaurant, the difference between those two can make your financial statements very misleading. Here's a simple example. You receive a big food delivery in the last day of the month, but you don't pay the invoice until the following month. That's pretty common, pretty standard procedure. Hopefully you're on at least a 10-day terms, if not 30-day terms. On the cash basis, that expense, more accurately, that inventory shows up in the next month when it's paid, not in the current month when you actually received it. Or that expense shows up in the next month when it's paid, not in the current month when you actually incurred that expense. But you used the food this month. So this month's food cost looks artificially low. Next month's looks artificially high. Neither is accurate. And if you're taking inventory monthly like you should be, then it really gets confusing when you record transactions on a cash basis. Accrual accounting matches expenses to the period they belong in. It gives you a true picture of what actual costs to operate your restaurant that month. If you're making decisions from cash basis financials, you may be looking at it, you probably are looking at a distorted picture, not maybe, especially around month end when timing of payments shifts costs between the periods if you're on a cash basis. You absolutely need to be running your accounting system on an accrual basis of accounting. Here's a strong opinion. If your bookkeeper or accounting service is providing cash basis financial statements, those financial statements are worthless. I might call that malpractice if an accounting service is actually doing that for you. So we go deeper into that in week 7, building your operating plan, and week 9, mastering cash flow. All right, breakdown number 6, reports that arrive too late to act on. It's what I ask most restaurant owners. When do you actually see your monthly financial statements? The answer is somewhere between 3 weeks or more. And for a lot of owners, it is. Then by the time you see a problem in your financial statements, you already lost 3 or 4 weeks of margin. Financial reporting needs to be timely enough to be useful and so it can be acted upon. The big chains don't work for a monthly P&L. They generate daily and weekly reports that summarize sales, labor, food costs, so they can make corrections while they can still do something about it and have an impact on the current period. You don't need a corporate IT department to do this. A properly integrated financial system with your point of sale and your payroll and your payable system flowing to your accounting software can give you the weekly flash reports that show you where you stand, not where you stood a month ago or more. That's history. If your financial reports feel like a history lesson instead of a management tool, the system has a gap. We went deeper in week 1 on the 5 moves. Week 5, building a labor budget for period sales and labor log as a daily tool. And we'll go deeper in week 8, streamlining your financial data, your financial systems and data. So breakdown number 7. The last breakdown is the one that ties everything together. You can have a great chart of accounts, integrated systems, accurate food cost data, timely reports, but if you don't have a financial plan for your restaurant and for your team, you have no way to measure where you're winning and losing. An operating plan is your restaurant's financial GPS. Some people call it a budget, which doesn't sound very fun because it connotates cost cutting. So think of it as a profit plan, not a budget. And just like a GPS, it tells you where you're headed and whether you're on course. Without it, you're driving without a destination. You might end up somewhere good, but you wouldn't know it, and you certainly couldn't repeat it. Your operating plan should be a 12-month rolling financial plan built on your actual historical data as a starting base, then customizing the 12-month rolling forward plan to your concept, your market, and your definition of success. Make it your own plan based on your definition of success. And then you build improvements into your plan based on what you want to achieve and where you want to land. So your restaurant starts to reach its full financial potential based on your plan. And then every month, you compare your actual results to that plan. Where are the variances? What caused them? What do you do to adjust? The cycle is plan, execute, compare, and adjust. That's how restaurant owners take control of your financial outcomes. So we'll go deeper in this in week 7, building your operating plan next week, and you won't want to miss it. All right, here's the 7 most common financial system breakdowns we just covered. It's the chart of accounts is not built for a restaurant. The point of sale system is not integrated with your accounting system, synced up and mapped correctly for every single detail in the point of sale system. You don't have back of house or front of house labor separation and by detail position as well, so you can make your proper planning and scheduling. Food costs calculated from purchases, not the real food cost formula. Cash versus accrual confusion, distorting the picture. You should absolutely be on an accrual basis of accounting for your financial reporting. Ask your bookkeeper, accounting firm, whoever's preparing your financials, are we on a true accrual-based system? If you're not, you're getting distortion. Reports arriving too late to act on. You're looking at history. You're not making decisions in real time. And there's no operating plan to measure your results against. The cumulative effect is you're flying blind. Strong profits and healthy cash flow aren't accidents. They're outputs of a strong financial system. And the strong financial system starts with seeing clearly where the gaps are. Now, we just walked you through the 7 system breakdowns. And I'm guessing that as you were listening, you recognize your restaurant has at least a couple of those breakdowns in place. This is not a criticism, it's normal. Most independently owned restaurants have these gaps because nobody ever showed the owner what a complete financial system looks like for a restaurant. You didn't go to school for this. You opened a restaurant because you're passionate about food and hospitality. And the financial infrastructure piece got built on the fly, mostly based on tax return compliance reporting, which gives you no financial operating insight for your restaurant. That's exactly why we created the Restaurant Financial Systems Scorecard. It's a free self-assessment that walks you through the key areas of your restaurant financial infrastructure, your accounting setup, your prime cost visibility, your technology integration, your reporting, your planning, and it gives you a clear score across each area. It takes about 10 minutes, and when you're done, you have a high-level picture of where your financial systems are strong and where the gaps that might be quietly costing you money are. Not a guess, an actual score. Think of it this way, all the cash flow and profit improvement tools we've covered in this training series and will cover in the coming weeks, they work better when a financial infrastructure underneath it is solid. The scorecard shows you where that infrastructure stands right now. I'll drop the link in the comments below this video. So click the link, take the scorecard, see where you stand. It takes about 10 minutes, and it might be the most useful 10 minutes you spend in your business this week. Okay. Next week, we already talked about this. We're going to get into how to build a 12-month financial plan. I'm going to show you how to create the 12-month plan for your restaurant that turns your monthly financial reporting from a history report into a management tool. If you've never had a financial plan for your restaurant, or if the one you have hasn't been updated in a while, you won't want to miss next week. Thanks for joining me this morning. I know today's training was a little different from the last few weeks, less tactical, more diagnostic, but that's intentional. Sometimes we need to step back, and the most valuable thing we can do isn't to add another tool. It's to step back and make sure the foundation underneath everything is built on solid ground. If this was useful, follow our Facebook page here. I do this every week so that you don't miss a week's training. Have a great week, and we will see you next week for planning and budgeting.